Hello, Alex, Christian. Thank you so much for joining us on another episode of the TDAM's Breadth of Experience. Now, we've been doing this show for a while, and I've had the fortune of having a lot of great PMs, but someone told me they're all equity PMs. And you know what? I'm an equity guy through and through. That's my background. But this is Breadth of Experience, and TDAM has a ton of expertise across the entire spectrum. So Alex and Christian, as first-time guests, why don't you tell us about yourselves? What do you do at TDAM?
Who's going first? Me?
Go ahead.
Okay. Well, thank you, Jose. I think both of us feel very honored that we're the first non-equity PMs to be on this. The name's Alex Gorewicz. I always tell people, don't call me Alexandra. That's reserved for my mom when she yells at me. But I'm a fixed income PM on the active portfolio management team.
Perfect.
Yeah, Christian Medeiros, portfolio manager on the asset allocation team.
Nice. What have you been, besides the titles and the role, what has your journey been to get to TDAM, and how'd you end up in fixed income and asset allocation? Yeah, what's the story here?
I joined as a rotational analyst 10 years ago, so I rotated through different teams at TDAM, getting a feel for everything. Then was lucky enough to join the asset allocation team right after the rotation. It kind of fit my studies or background, which is more focused on global economics and politics through school and through prior internships I had. And then from there, I've been on the asset allocation team for 8 years, and throughout that role, taking more and more senior roles and moving into senior portfolio manager.
So you tried all asset classes and you were like, I want to do everything.
I want to do everything. Yeah. I couldn't decide. I couldn't decide.
Alex.
Okay. So, a lady never reveals her age, but I started as an intern at TDAM.
You're
Believe
still
it or not, before
a
the
teenager.
financial. Thank you.
Yeah,
yes.
that's the right
sometimes
answer.
I feel that way. Yes. So I started as an intern at TDAM. Believe it or not, like right before the financial crisis.
What a time.
Yeah, that's right. So it was an interesting time. And I always joke that nobody ever wakes up and says they want to be a bond manager. So bonds found me, not the other way around, because I have a very sort of technical, quantitative, mathematical background. That's what I studied in undergrad. And then I wore them down, got a full-time job at TDAM in their portfolio analytics and research group, and then eventually found my way to the fixed income PM team. I'm a boomerang, so after that experience, I actually left the organization for some time. And then 4 years ago, I returned also as a fixed income portfolio manager.
Oh, yeah. Well, I wasn't even, when you said a boomerang, I was like, wait, what is that, another term for advanced boomer or something?
No. And then I was here, I left, and I came back.
Okay, that makes sense now. Okay, fantastic. So we have an incredible experience here. Your career has spanned quite an interesting time. Let's just call it that. And so I think that's a perfect segue for what a time to be in the markets this year, 2025. Just off the top of your heads, what are your thoughts of 2025 so far? And yeah, it's been exciting to say the least. So in your words, what do you think of this year?
Well, let's just say in January of this year, I was already looking forward to 2026.
Oh,
there you go. That summarizes it. You don't need to hear anything else from me.
Yeah, it's been an exciting ride. Obviously, with Liberation Day in April, I think that kind of threw things for a lurch. But since then, it's been quite sanguine. Vol's been really low across all asset classes. I think under the surface, it does hide some big divergences. For example, like if you look at equity markets, some of the best outperformers are emerging markets, peripheral Europe, even Canada's performed strongly.
Seems like, yeah.
Whereas, if you're predominantly invested like in U.S. equities, which most of the world is, on a currency-adjusted basis, the returns are okay, not that great compared to the rest of the world. So it's been a year where currencies mattered. It's been a year where international diversifications mattered. So I think it's pretty interesting and different, despite the fact that on the surface, everything seems very calm and low volatility.
But underneath, I'll ask both of you, what is something that caught you by surprise this year, and maybe what is something that played out as expected in some sense?
If I had to say something that caught me by surprise this year, it was that despite all of the fear and concern and rhetoric around ballooning budget deficits globally, bonds are still positive on the year. Who'd have thunk it? And then in terms of what has played out as expected, around Liberation Day, I mean, to Christian's point about that being a very like vol-inducing event, we did see credit underperform within bonds.
Yeah.
We did see a lot of risk off, but that came back really quickly. And I think that met expectations because at least in bond land for a couple of years now, we've seen this like huge demand for all-in yields. And although, interest rates have come down year to date, they have come down over the last almost 2 years, they're still really elevated by historical standards. And you're just seeing this sort of insatiable demand for bonds just because, hey, they pay coupons. And guess what? In order to realize your yield, you have to reinvest. So it's an interesting time.
This is a funny point you mentioned, right? Because my career too started in the 2010s sometime. And if I remember pre-pandemic, the only question was, where's the yield? And now it's completely flipped a 180. So just big picture, like ultimately you said, bond math is the math of finance, right? At the end of the day, it's pricing risk. So from 1980 to 2020, effectively, we had this huge kind of era of one-way yields down.
Mm-hmm.
Have we changed? Are we in a new regime altogether for thinking about bonds?
I think part of the challenge is that the 70s and 80s are usually used as a reference because we'll call it a local max in yields. When I say local, I mean take into account the hundreds of years of like...
for the longest time, it was like almost non-existent, right?
Correct.
Yeah.
So the reason I say it's like some kind of local max is because that for some of the more seasoned professionals in the business, that would have been sort of the last known like peak in yields. But it's possible that was the aberration historically.
That was the anomaly.
Yes, that was the anomaly. And the environment we're in today, where it's not like the 2010s where yields were close to zero, but it's not like the 70s and 80s when we had double-digit yields either. Somewhere in the middle, somewhere like, we'll call it mid-single digits. That's probably sort of the normal historically. And that's plus or minus where we are today. And what that's showing us is that it allows bond investors to weather a range of vol-inducing events in markets where you could still come out ahead. You might not be, double-digit returns, but you won't be at zero or negative either.
So in some sense, are you saying, like, is fixed income going back to literally what its words kind of mean, right? Like fixed income,
correct.
The income aspect.
The income aspect, yeah. So that's interesting that you put it that way because in a lot of my advisor and client presentations, I've said if anybody asks me what has changed in bond land after, let's say, 2022, it's that there's income again in fixed income.
Nice. From a multi-aspect perspective for you, Christian, how are you thinking about bonds?
Yes.
From the overall picture? Yeah.
Yeah, great question. I think when we think about this long-term trend that you're talking about, one way we like to sort the world in asset allocation is into growth and inflation quadrants. So high growth, high inflation, and there's all four permutations. In the 2010s era, we were in pretty low growth, pretty low inflation the entire time, and that was a specific regime for fixed income. The all-in yields weren't that attractive, but it did provide you a lot of diversification versus equities. It was quite negatively correlated. So it actually helped your multi-asset portfolio. Our view now is going into the 2020s, it's a lot more volatile in both growth and inflation. So we're going to pop around those regimes a lot more, and we have been since 2020, moving around.
Yeah.
And in that regime, sometimes fixed income won't give you negative correlation. It won't diversify your portfolio as much. There'll be periods where they're positively correlated, like in 2022.
And even Liberation Day.
Liberation Day as well.
Yeah.
And so in that case, you probably need more alternatives beyond just fixed income to diversify your portfolio. But on the positive side, to the credit point of view, all-in yields are actually quite attractive. And if we look at capital market assumptions for equities, usually people assume long-term equity returns are high single digits, let's say. But you can get mid to high single digits in a credit portfolio at this point with substantially lower volatility.
Yep.
So especially for someone who's goal-oriented or income-oriented, it's a pretty attractive total return, especially assuming credit spreads stay relatively tight. So I think it's very different than the 2010s for sure.
So to kind of take it back in that sense of yields, to that question of what is, on a first principles level, what is driving this yield? Is it the risk or is the market pricing and growth longer term? what is the source of this move up?
I think it depends on the market that you're looking at, the country you're looking at.
So let's break down. Let's dive a little deeper then. At least let's start with the U.S.
Okay, so actually, if I were to compare and contrast Canada and the U.S., I'd say in recent weeks, one observation that my teammates and I have been making is that when you look at the growth expectations, I should clarify, growth expectations for Canada, they're actually quite elevated relative to where they have been for the last couple of years, but the data that's coming out is sort of consistently missing those expectations, which is probably why we're looking forward to the November, budget and seeing
the equity market is running up ahead already.
Yeah. I know. We have screen. We look at the equity screens too, just so you know. But it's funny where you compare and contrast that with the U.S., where expectations for growth continue to be sort of like lower and lower, but the data is actually beating that.
Yeah.
Right. So you have So then you have to start looking under the hood and trying to understand where are, at least from the bond market point of view, where are investors sort of pricing higher long-term risk premia.
Right.
So when you think about how Christian broke it down in terms of how the asset allocation team looks at it, quadrants with growth and inflation, those concepts loosely are tied to what we call real rates in bond land and inflation expectations or inflation break-evens. So when we look at real rates and break-evens, we can decompose for long-term. Like, how do you forecast 10-year interest rates?
Yeah.
I don't know. Like, I can't even forecast what's going to happen in a month from now. Like, how do I do that in 10 years? So you kind of guess at it. And we can decompose each one of these things into really like two concepts. One is the expected level over the next 10 years. And then the second one is like oh, shoot, what if I'm wrong on that expected level? And there are a lot of things that are making me question the confidence that I have in that forecast. So that's what we would call the term premia. And both inflation and real rates have that term premia. So when we look today, for example, in U.S., not so much Canada, in U.S., where that the just in case I'm wrong in my forecast is coming through, it's really on the inflation side. So it's in a way the market is saying, I don't have a ton of confidence that the Fed's going to get back to 2%. They're not pricing in runaway inflation either, but there is a risk that's being demanded for the just in case I'm wrong on the expected level of inflation. In Canada, I would actually say it's more on the real rate side, where you're seeing that sort of higher for longer rate regime, or certainly we're putting the 2010s behind us. That's actually manifesting itself more on the real rate side.
Both of these sound generally positive for the economy to some degree, right?
Yeah, I think so. I think that even the inflation, the firmer inflation piece for the U.S.
It's not necessarily bad, right?
It's not necessarily bad unless you start really like ramping up that inflation expectations. Right now, because it's just the term premia, really that uncertainty premia, if you will, that's manifesting itself in the U.S. bond market. It's not the expected level of inflation. I think a lot of assets are taking it as a positive sign that, they can do their own thing and not pay attention to that. Christian, you can correct me if I'm wrong. But if that expected level starts to increase in a meaningful way, not from like 2.5% or 3% to like 3.5%, but like to 5-6%, then you're going to start having problems. That's not my forecast, but that's something that we would have to monitor. And that's where it's important to get into the like details of what's driving things.
That's handy. Yes.
And that same concept is the same as like nominal GDP, right?
Yeah.
Like the inflation component and the real growth component.
Yeah.
And the difference versus the 2010s is then we had extremely low nominal GDP. And now in a world where it's materially higher, and a lot of that's partially policy. We have much higher fiscal spending. We have a lot higher growth industries like AI. We have a lot of countries doing different things than they were. We had a big inflation push because of COVID. We have different supply shocks now like tariffs. We have immigration changes. So all these things are kind of pushing nominal GDP higher, whether it be from the inflation or the growth side. And in a higher nominal GDP world, if you think about equities, earnings are not just increasing real GDP, it's also the inflation that they can pass through too.
They can pass through.
So it's quite positive for earnings and equities. For bonds, it's mixed. It depends on the breakdown. And so, yeah, it's a very different world with higher nominal GDP. So I think that's like a big difference to keep in mind when we're allocating in the current decade.
We said U.S. and Canada. To some degree, can we argue that this is just competition is back between countries, between regions? They are investing, they're reindustrializing, they're focusing. If you can touch upon that, and also the nuances between what's happening in North America, also Europe, because Europe seems to be going through a slightly different version. It's still yields going up, maybe different reasons at least, or different causes. Or is it the same? I don't know. What's your take here?
Yeah, I mean, on the geopolitical side, since World War II, we had the U.S. maintain security and normative world order.
Yes.
Whether it be trade, whether it be global institutions, whether it be financial architecture, that was quite beneficial to the U.S. and the rest of the world because it resulted in liberalizing trade, financialization of the economy, security architecture that allowed countries to not have to overly invest in defense. But that clearly started changing probably, I think, started in the early 2000s after Afghanistan and Iraq war.
It's a longer-term trend,
It's a longer-term trend.
Even though it feels like it's now, but this has been going on for some time,
and
right?
Even Obama started to pull away a little bit as he was pivoting to Asia, trying to compartmentalize where the U.S. cared about in the world. And then with the first Trump administration, that was completely blown open, as it's a much more domestic-focused, nationalistic agenda that's trying to, do things on their own and improve their own lot with policies that they think are best suited for them, and that's mostly domestic-oriented. It's a different view of the world, but it's not a view of the world that hasn't been tried in the U.S. and other countries throughout history. There's been a lot of U.S. administrations prior to the Second World War that tried similar policies, so it's not necessarily new. I think geopolitics goes through cycles, and this is a different cycle that we're in today. But what that means is that the U.S. is not going to necessarily, for free, maintain this international architecture for other countries. So other countries have to, on their own terms, negotiate, do some self-help, invest in their own defense. So it's a rude wake-up call for countries that overly relied on the U.S. geopolitical architecture. But in some ways, I think it's also a big opportunity from an investment point of view.
Right.
There's a lot of countries, I call it self-help stories, where they previously underinvested, they had a lot of imbalances, now they have to take their lot seriously. And there's a lot of examples this year. Earlier in the year was Germany with a huge fiscal package, including defense.
Which is kind of stunning, right? This is a country that is, you could call them the Scrooge McDucks of nations, right, in terms of spending.
Exactly, and that kicked off huge outperformance for European equities, a massive move in rates for boons. Then, closer to home, Canada, we had a pretty tepid decade of growth and economic data, and it was getting a little bit worse towards the end of the last Trudeau term. With new elections, we thought that, hey, there's going to be a change in pace, and we've seen a lot of policy we can maybe talk about later that looks more positive for Canada, and we've seen some better Canadian outperformance since then. And I'll just name a few other examples, like Korea. The president there not only launched the biggest fiscal package, but he said, hey, our equity markets are severely undervalued.
Yeah.
I need to fix this because it's going to help our national wealth.
They're trying to do what Japan did with Japan's market.
So you have a lot of these stories of self-help. And one last one, and I'll stop talking. The pigs in Europe, we can all remember from the early 2010s. Yeah. Terrible countries. Oh my God.
They're great, right?
Now they're fantastic.
Yeah.
They've got debt to GDP down. They have the highest growth in Europe. Their equity markets are outperforming. So it's a really interesting world.
This concludes part 1 of our Q3 market wrap-up. If you found that helpful, make sure to check out part 2.